Ho ho ho! Merry Christmas! D7 here with Grok Trade. First chart we're going to be looking at is the bond yield inversion. The reason we're going to do that is because it has 100% accuracy. 100% accuracy on what exactly? It predicts recessions. Long and short of it is the upper orange line that we see here is simply the S&P 500. It is the markets. It's the markets that go lower left, upper right. That's where we're at. We're up here near the all-time highs at this very moment. You can see that here. But what we're analyzing is the 10-year bond yield versus the 2-year bond yield. And that average is right down here. Anytime it goes below this horizontal red line, that means you have what's called an inversion, which very seldom happens. It's happened around a half a dozen times going back in history. And during that time, every time we have dropped, it has 100% been accurate on identifying a recessionary pullback. So, for example, you can see that we went below here, and this was the 1998 big correction. And if you come here, this was the 2000 and technology bubble. I mean, the huge drop in the markets when the tech bubble popped in 2000. And you go over here and you have the Great Recession right here, 2008. And that was a monster drop. You can see it here. Monster drop after these inversions. Again, blue line underneath this red line is no bueno, is no good. Recessions come after that. And what's interesting, you'll see that we have one right here. Do you see how we go barely under and pop back up? Well, what's crazy there is we had an inversion, and this was the 2020 market crash that we had for the COVID crash. And what's fascinating, I don't know what the correlation is with an inversion and then the biggest drop we have seen since the Great Depression, as far as how fast it dropped. The Great Depression only beat us by 3 days. So that was a significant drop, but interesting correlation. But if you look to where we're at right now, we've been in the longest and deepest inversion we have ever witnessed in all of history. And the thing that we're looking for is when this inversion is no longer inverted, meaning that 10-year bond yields are paying more than the 2-year bond yields. That tells us we have 1 to 4 months before a recessionary pullback should begin. And studies show, research shows that it's the average of 100 days. So an average of about 3 months before you'll get that recessionary pullback in the markets. This is why we look at it, because right now, very few things in life have 100% accuracy. So far, this one does, but the occurrences are very few. For that reason, anything can change. All I know is that's the deepest and longest inversion we have ever been in, and every time we've had one, we've had a significant economic recession take place with double-digit unemployment, which also coincides with the bear market. All right, let's get after it. Oh, hold on. Hit the wrong button here. Using Trading View, I'm able to hit this little back button there, and we do use Trading View here. But we're going to look at weekly charts, and here's why. Because, guys, we've had this significant Santa rally. This thing kept going up, up, up. We kept hitting these areas of resistance and blowing right through them. Another area of resistance, blowing right through it. Another area of resistance, blowing right through it. That is a telltale sign of a Santa rally. And do some research. Find out Santa rally. Speaking of that, I should quickly show you guys. If you go over to freeonlinetradingeducation.com, go to more, click on market close dates, and everybody should know this real quick. Everybody should know that if you scroll down here, that there's only one day off. Christmas, Monday. Next week, it's going to be a 4-day work week. Enjoy yourself, and that's great, right? But this is where you go. Mark down all the other dates. You can see it here. It's worth putting this in your bookmarks. But anyway, going back here to the charts, I want to show you guys a couple things. The S&P 500, if you look at this weekly chart, that we're going higher here. But if you are a highly educated technical analyst, you'll know that we have a bearish divergence on the MACD and one happening on the RSI. No bueno. But look at this red line coming across here. Do you see this red line? We're right there at it. What's interesting is we do have a higher weekly high, higher weekly low. So it's still going higher, very extended here. And if you look at the RSI, we're overextended. Can it continue to be extended? 100%. Can this keep going higher? 100%. It can. But here's the deal. I've been trading in the live markets 20 plus years, and we're at major resistance after a big extension, and we have bearish divergences and compared to price action at a major high. And this major high just isn't any major high. It's the last major high we have seen in all of history. We're there again. Last time we reached this area, and if you go watch my videos from back there during this time, and it was at the start of January 2022, guys, when I said chances are if we're to break down, we will not see those highs for many years to come, and we haven't reached those highs yet. We still would have to go up to the 480 mark on the spider to reach those highs, and I'm not sure we're going to be able to do it with what I'm seeing here. I could be wrong. This thing could just keep marching higher, but it would defy odds. How many times you see legs going up at this level of trajectory that has lasted that long? Look at see this trajectory? It's shorter than this leg, and then you get this massive snapback. Okay, so it's very important. Trajectory matters. This is going straight up. It's like a rubber band going straight up. It snaps back. That's what can happen. So we have to watch out for that. You don't want to be the one that's just biased to the bull side and have your head handed to you if and when this thing snaps back. Let's go to the diamonds weekly chart. Straight up, 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 up. Extra bonus points in the chat box down at the below. If you can tell me what that reversal pattern is, okay, down in the description, not description, down in the, leaving the chats. Speaking of chat, man, I got to show you guys this. If I go over here to this thing, if I roll this up, this is Grok Girl, guys. If you click on Grok Girl, you could ask anything like, what is swing trading? This is artificial intelligence. This gal is sharp, okay? What is the difference between a ETF and mutual fund? So she tells us all this. And so you could say, where can I search for stock ideas? And give you, she is a wealth of information, and she's snarky too. Are you snarky? Oh, honey, Snarky is my middle name, she says. This is crazy. And, she is so fun, so witty. She's the smartest trading pal you will ever have. So feel free, tell me about the Grok mentors. Bam! So she'll go in here and tell all this stuff. Doesn't matter. Let's get back to stock trading, okay? Now that's the diamonds. What type of reversal pattern is that? Go to the Qs. This is the NASDAQ. Tech heavy. Tech heavy. If you look at this, look where it stopped, guys. It stopped right up here at this red line. But the question is, what is this red line? That's these previous highs. We're at those previous highs. Last time we were there, major drop. Major drop. Remember 2022, guys. Major drop. Okay. So now we're up at these areas again. MACD divergence, RSI divergence, and if you go over here to the Russell 2000, look at this, we're over here, but we're not at all-time highs. Russell 2000, very laggy compared to the rest of the markets. We're not challenging all-time highs. This is something that's noteworthy. You guys should pay attention to this. We're very extended on the MACD. It's been a long time since the MACD has been this high, and a long time since the RSI has been this high. If you look, the last time the RSI was nearing this high, go up, 2022, big crash after that. That's where we're at now. And again, small caps, they are deemed riskier, are relatively much weaker. And that's where we're at. We're up here at these highs. you can see those coming across here. If you go to the financials, what's the financials doing? The financials also not at near these highs again, relatively weak. So you got financials and you got small caps relatively weak compared to the rest of the markets. And the thing I want to show you with financials, very important that you look at this. Out of all the charts I just showed you, this is the first chart on the weekly that has a lower high, a pivot candle. We're looking at the lower high with a doji. So we have a doji on a lower high, and we have a trend line coming up showing that we're not able to get to this trend line again. It got there here, got there, got there here, got there here. So it right now is saying it's having a hard time getting up there. We're very extended. MACD looks like it's getting ready to roll over, and we're over at the RSI overbought level. Quick look here at the US dollar. We're down, symmetrical triangle breakdown this week. The US dollar got very weak. Broke this big time. Now, what we don't want to see if we're bearish, okay, or if we're bullish. If we're bullish in the markets, what we don't want to see is the US dollar do what's called a bullish death hook. Look up bullish death hook on Google. Go and check that out. Bearish death hook. If it comes back into here, the US dollar will rally strongly, and that will put a ton of pressure on gold, silver, all other commodities out there, including stocks, okay? Now, if we stay weak, say under this trend line, US dollar stay very, very weak, look for gold, silver to respond really well, and the stock markets to keep buoyant, okay? And gold weekly chart. It was starting to drop, but we rallied back. But we touched this trend line. You can see the trend line right there. We touch it, and it's getting ready to come down. and silver, if we go here, we get this bounce going up. We're caught up we're above moving averages on the weekly chart, but we're just caught up between these two trend lines. And VIX spiked up last week. Wednesday and Thursday, markets got really bearish pretty quickly, and then Friday bouncing back. Up, up, up. Now you have an inverted hammer, The question is this a tell before we start to run higher? We had an inverted hammer here, dropped down a little bit, and then we shot up, pulled back, shot up again. So the inverted hammers can be a tell, you know, that fear could be increasing. I don't know if that's going to happen. We could stay down here forever. But I can tell you, we have a crossover here on fear. And we have a bullish divergence on fear. So it's this is very, very bullish formation. We should be going higher. RSI dropped and hooking up and heading higher. So it could be getting dangerous. My next video I'll be doing to close out the year could be very interesting for people. May not want to miss that. This will be the last video you ever see from me unless you subscribe. It doesn't cost you anything to subscribe. It doesn't cost you anything to give me a thumbs up. I mean, give me a thumbs up. It doesn't cost you anything. Subscribe. If you don't like what we have going into the future, feel free to unsubscribe. But the reason I bring this up is because in 2022, some of the same things we're seeing now, and that is the markets going up, 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 getting to these extreme levels, and then at the beginning of the year, after the Santa Claus rally, the markets come crashing back down, And I don't know if that will happen going into 2024, but I do know that I have a bond yield inversion in place. And one day that's going to correct itself. And the question is that going to beat all statistical odds and do something it has never done before, and the markets not go into a bear market and the economy not fall into a recession? Could happen. It's plausible. But statistically speaking, as soon as it corrects, the time has started. The ticker has started. And we should go into, historically speaking, a recession and a bear market and double-digit unemployment with a 20% drop in the markets itself. And I think the more prudent people will be watching for that and preparing for that. Next video, we'll go into great detail than what we're doing here. So I hope this was helpful. Now, before I sign off, thought about this. I was going to rant and let my emotions show. Not going to do that. Man, I hit 50 this year. Hopefully that brought some wisdom. I have gray hair now, so they say, you know, there's a correlation. But I have been catching some heat from some of you guys on you're missing your calls. You called this and it didn't happen. You called that, it didn't happen. You called this, it didn't happen. Here recently, my thumbnails will have toppy, the top, capitulation. So those thumbnails, if you watch the video, and I highly recommend you do it again and listen to it with unbiased ears, you will see that we talk very pragmatically about technical analysis, analyzing all the things that I deem relevant in technical analysis. I used to think all these indicators and oscillators and everything had merit. I don't think that nowadays. I think it's price action and volume and a couple key indicators. And those indicators by themselves in their own rights don't hold much weight, but it's the analysis of the indicators associating as a support to price action analysis. Charting on price action is key. Whoever learns price action best wins, period. No ifs, ands, or buts. Learn it better than everybody else. That's the secret. It's a public forum. Anybody can leave their opinions. Please do so. And if you disagree with something, I'm okay with that. Don't be rude. No need to be nasty. Let's all have a conversation. I don't have to do these videos. I'm a trader first, educator second. A lot of people say, why do you have an education company? Because that's where I came from. If I didn't have the requisite education, the specialized knowledge that was taught to me, I wouldn't be where I'm at today. I couldn't do videos like this. I couldn't be in a position to be able to show you what I'm seeing in the charts on a regular basis. And because of that, we too want to get back. Do you guys know that we only teach 3 days out of the month? The rest of the month is for us, for our own trading and our own endeavors. That's for us. However, we'll do 3 days a month, and we'll do it in a small group. And people who want our mentoring know how to find us, and they find us, and they come through. We don't advertise. We're not begging people to come through the program. It's one of those things that there's no faster way, none, period, no faster way to learning how to trade successfully than through a mentorship experience. The more books you read, the cloudier things get. The more YouTube trading things you watch, the more cloudy things get. The more market research that you do, the cloudier things get. You put all the book knowledge with all the YouTube knowledge, all the interweb knowledge together, it becomes a black hole of a mess. I speak from experience. I remember. And what cleared the fog for me was a mentor. That's the only reason why that's what we mentor. We don't offer books. We don't offer those other things. We offer mentoring because that's what did it for me, and that's what does it for everybody else. We got great reviews out there. But all I'm saying here is we care about you, and we love our community. This Grok ecosystem is very healthy. We love all of you, and we love this community we have put together, and where we lock arms and we learn together, and we go. I'm still a student of the markets. Every day I'm learning, and the markets are a teacher that will always be there. It's an everlasting teacher. The markets are. And so it's just fantastic. It's a great thing. And listen, from our team here at Grok Trade and our families, each of our families here at Grok Trade, to you and your families, we wish you a very Merry Christmas. The reason for the season is Jesus Christ and his birth. And we give you guys much respect. Thank you for being a part of this community, and we will be in touch. I can't wait until this new year. Take care, guys. We'll see ya. Bye.
Guys, Why are you still here? You just watched my video and now you're still lingering around. Might as well be with you now that I have your undivided attention. Listen, if you haven't done so yet, I highly recommend putting in a foundation of trading, your foundation of trading through a mentor. For learning to fly a plane, you wouldn't just go through ground school before you start flying in the friendly skies. What you would be doing, though, is going up first with your flight instructor. Same thing if you were going to learn to ride a bike, you better have somebody behind you helping you ride a bike. Surgery, you're not going to read a few books and do heart surgery. So every principle in with being guided by a mentor, let finances be this. If you're a trader, you rate you from amateurs to professionals. Mentoring will do that for you. Anyway.